Good morning and welcome to the Funding Puzzle. Really pleased you could be with us this morning. We're going to be discussing how to build this puzzle today, how to unlock access to finance for entrepreneurs and SMEs. So you're in the right room. I'm Rowan, the CEO of the CFO Centre South Africa for the past 14 years. We're part of an international CFO practice headquartered in the UK with a footprint in 20 countries around the globe. So what are the key aspects to raising finance? And what's included in today's session? Well, we'll be talking about funding applications and creditworthiness, sharing tips and insights on how to succeed with your finance applications, preparing the financials, that's getting the numbers right, understanding the cost implications of debt finance and how to manage this over the finance term. And then a little bit about what the future looks like. So, without further ado, I'd like to extend a warm welcome to our panelists and thank them for participating and sharing their wisdom and insights with us today. Before proceeding, I'd just like to let you know that we will take questions from the audience a little later. So kindly prepare your questions to post in the chat box following our panel discussion. Thank you. Right, we're going to move over to Wayne Jaggard, our first panelist. So I welcome you, Wayne. Right, Wayne is a regional director at the CFO Centre in KwaZulu-Natal. Wayne has 25 years of experience. He's been with us for 10 years. He's augmented his CA qualifications with an FCMA and an MBA qualification. He has also worked as a chief operating officer. His diverse experience enables him to bring a comprehensive perspective to the discussion. Wayne's approach focuses on providing optimal value to clients. He looks forward to sharing insights and tips from his experience to help increase the chances of success with funding. So Wayne, I'm going to kick off with a loaded question for you. If you could share some insights, please, regarding your experience over the years with raising finance for clients, and perhaps one specific example, and how did the process flow, and what obstacles were involved?
Yeah, Rowan, thank you so much, and it's really an honor to be part of the panel today, so I do thank you for the invitation. So, Rowan, diving straight into your question, I think, the example I'm going to give you is one that our clients are within the CFO Centre, where we raised funding for a software development. I've chosen this one because software is inherently difficult to raise funding for. And, some of the insights that I had in this process and that I wish to share today with our audience is as follows. First of all, make sure that what you are seeking funding for actually adds economic value, okay? What you are seeking funding for must be adding value. What does it mean? That means that the returns that that's going to bring are going to be greater than the cost of that funding. Now, that might sound quite simple, but there's often a fundamental error in people's approach to this, in that they want to fund something but don't understand the full economic aspect of the funding. So my first point is very clear. Make sure that there's economic value that's being added. The second point is target funders who focus on the type of financing that you are requiring, okay? There's a vast variety of financiers or funders out there, and we're very privileged to share this platform with some of them who will give us some of the insights later. So it's a little bit of a horses for courses, okay? If it's mezzanine finance, go to people who focus on mezzanine finance. If it's working capital, go to working capital financiers. If it's CapEx, go to CapEx. And remember, within capital expenditure, there's various guys who focus on different things. There's certain institutions that will have broad funding areas that they look at, and some that are very narrow. So the point is just make sure that you're asking the right people for the funding that you are seeking. The third point that I'd like to make is be realistic, okay? Often we see these curves of sales growth that are going to go through the roof, okay, the classic hockey stick approach. And it's vitally important that whatever sales assumptions you're making in the funding application, those are pegged to something. There's a logical and realistic underpin to that, okay? I mean, that's vitally important because it's going to give a sense of comfort It is going to need some degree of market research, but you have to peg this thing to something that approaches and approximates reality. Okay. And then the next point is be very clear about what you want. Okay. Too often we see proposals come in before we send them out that it's just a dump of information and analysis. Okay. Without setting out a specific request. Okay. I want 5 million Rand. This is what I want it for, and this is what it's going to be used for, and this is the justification for it. This is how it's going to be earned, etc., etc. So those are all really important aspects to look at. As regards the process, I think the processes are very predictable. I would say that it's very important that you right up front understand from the financier what the process is that they're going to be following and the timelines. Okay, because sometimes these timelines can get extended. And our experience is that a shorter, sharper process is far more effective than a long, projected one, because things happen, and not least of which your projections have to be updated, etc., etc. So really to be focused on the process. And then just to close off on some obstacles. So here's one that many people won't like to hear, but sweat capital counts for very little. Okay. And why I'm saying this, because in the example that I'm using, there was software development that had a lot of sweat capital in. Okay, but that counts for very little. It's more the value that's going to be added going forward that the financier is going to be looking at than the sweat capital that you've applied historically. Okay, the owner's perception of value is often inflated. Okay, and just be realistic, be grounded. There's an emotional premium that owners of businesses add to their thinking, and that really needs to be taken out of the equation. Other obstacles could include security. And then also the details of the term sheet. And right up front, I would be asking for an indicative deal sheet so you can understand what all of those nuances are going to be in terms of the deal you're going to get. So to conclude, in this particular example, we were successful, and it largely because we introduced an issue around a royalty model. So the cost of financing wasn't prohibitive, but it did increase as the software gained traction. So and hopefully those insights are somewhat helpful.
Thank you, Wayne. There's some comprehensive insights there, and I hope there's some nuggets for people to take away. Thank you. So just feeding into that, so how do I become more credit worthy then as a business owner when I put an application in?
Yeah, thank you, Rowan. I think there are two elements to this. Some good practical stuff that a person seeking finance can do and make sure is in place. Things such as making sure your bank score, both for you personally, because there's invariably going to be a requirement for a security, but also for your company, okay, or the entity that's seeking the finance. Make sure that bank score is optimized, okay. Where possible, a degree of owner contribution is vitally important as well, and it just gives a sense of comfort to the financier. And focus on covenants. Okay, once you're in that funding, make sure that you're always complying with the covenants that are in place. Because when you have a breach of covenants, it makes your partner, which the financier is, nervous. Because if you enter into an arrangement and you can't keep those covenants, certainly it's an amber sign for them. I think my second element of questioning about the creditworthiness goes back to the first point I made, and that is to make sure that you are creating value in the endeavor that you are following, and know what that value is, and make sure that the financier knows what that value is, and that's going to drive the cash flows. Okay, so it's not so simple as saying, here's the cash flows. I think you need to take that next step and say, listen, this is the capital needed, this is the cost of these capitals, this is the value that I'm adding up over and above that. And a lot of the time it'll boil down to what your gross profit is in a manufacturing kind of or buying and selling environment. And so making sure that you've got real competitive advantages in place, that you also have a degree of uniqueness in your offering. So what is your differentiation? Those are things that are going to make the whole funding proposal more creditworthy and more acceptable. Thank you.
Excellent. Thank you so much, Wayne. And then finally for you, Wayne, just around the cost of funding, how do I make sense of this as an entrepreneur? Bank charges, interest, penalties. How do I manage these, especially over the term of the loan or the finance that I'm taking out?
Sure. Obviously these funding costs okay, are going to be costs that aren't readily welcome. Okay, it's a grudge purchase, it's a grudge cost that's being incurred. I think the first point is to realize that they're necessary costs. Okay, they're costs that go part and parcel of this process, and they're not always there, to enrich the funder. They're there also to drive behavior. Okay, so make sure you stay in accordance with the behavior. Ways of managing these costs are pay the debt if it's debt funding that you're receiving or quicker. Okay, and make sure that the penalties, that there are no penalties, or if there are penalties, they're predictable and you can actually navigate around those. Okay. And another tip that I've had, which I've implemented 2 or 3 times over the years, is seek to renegotiate into the debt term. Okay, so build it in, say we will have a formal review after a period of time, and that review, yes, can work against you, but it can also work for you. And if you can demonstrate that the risk environment, okay, is reduced, there's improved liquidity, the returns that you are targeting are being achieved, then it's really incumbent upon you to go back to the finance and say, listen, for the debt that's remaining, you can see that the risk environment is improved. So therefore, let us revisit the interest rates that are embedded in this. So those are some aspects that participants can potentially use. Thank you, Ron.
Yeah, some really great tips there. Thanks for sharing, Wayne, and appreciate your time this morning. We'll circle back a bit later once we get to the to the audience questions.
Brilliant, thank you.
So, thank you. I'm going to invite Quinton Grape now from the Preference Capital Group. He's the Chief Revenue Officer there. Quinton, welcome. Are you with us, Quinton? Sorry, it's Mervyn. I skipped to the wrong person. Sorry, I'm jumping around a little bit with my notes here. Mervyn Pillay, if you could please join us from Capitec Business Bank, and then we'll have Quinton after that. Hi, Mervyn. Are you there? Yes. Welcome. Good to have you with us.
Great. It's a pleasure to be here this morning.
Excellent. So, Mervyn, just to kick off, Capitec, how is Capitec helping alleviate challenges faced by SMEs in the current economic climate? And how would you say Capitec is sort of different versus other banks? Because we know a little bit about Capitec, but just share a bit more with us. Thanks.
Great. Thank you, Rowan. I think, I don't have to delve into the importance of small business. We all know that in order to create employment, stimulate growth in our economy, we've got to do it via small business. And the interesting fact that I read quite recently is that not only is small business creating large number of employment, but if you look at the return on assets, small business probably shows a return of 5%, medium business 7%, and large business 2%. From a return of assets point of view, small business is critical. I don't think I need to chat to many people around the history of Capitec. It's the youngest traditional bank. We've currently have the most number of clients, over 21 million retail clients. And I think the philosophy that has driven this growth in this business on the retail side is something that we want to bring into the business space. And that's simplicity and transparency. So using simplicity, transparency, we want to make it easy for our clients to do business for us. Rowan, just to touch a bit about what we do differently from the traditional banks, we've already launched an end-to-end online process to open an account. Now, if you look at the different banks, it probably takes you anything between 2 days to sometimes 2 months to get an account open. We simplified the process. You're able to open your business account with us online, and it can take you probably around 2 minutes. You will have your bank account number together with your online banking and have your cards delivered to you. I think, just the philosophy of the group is to be simple to understand, to have a fair pricing structure. So besides, simplicity, transparency, understanding our pricing structure, we will be one of the cheapest business banks in the country. Just some of the things that we've already started doing with our business customers, just to make it easy for them to do business with us. We've, over the past 2 years, offered a pre-approved overdraft facility. We know that in the small business space, record keeping is not where you'd like it to be. So clients have a problem, producing financial statements. We've looked at their transactional records with us. Based on that, we've offered them pre-approved overdraft facilities. We've streamlined our process to implement this, and we're able to pay these overdraft facilities out in a single day. Then we've extended that to asset finance, vehicle finance, up to R1 million with pre-approved clients. We said, here's approval, go and find an invoice, find the vehicle, and we will finance that for you. And then most recently, we've extended that over the past couple of months to include solar and generators. So we've simplified the process. We know the only two conditions we have for our solar and generator finance, as an example, is it has to be insured, and the warranty term must be as long as the finance period. You can choose your own supplier because we trust our clients that they will choose the best supplier available to them. And we even pay upfront the deposit that the installer requires. So these are some of the things that we've already started doing. We officially launch Capitec Small Business next year, March. But in the meantime, we still deal with business. And the more we understand our customer needs, the more we will try and retrofit products and services to suit our client base.
Thanks, Mervyn. Some refreshing insights there. It's nice to know that processes are speeding up and there's pre-credit approval for some products. So Mervyn, just following on from that, my second question is, how do you ensure that you have a good chance of success? Or how would I ensure as an entrepreneur that I have a good chance of success with my funding application? And how do I prepare a high quality funding application?
So let me give you the secret, Rowan. I'll tell you what we look at in an application. There's 4 key aspects that we assess any credit application. And the first is behavior. So I would say, create a track record for yourself. Make sure your credit history as an individual, as well as that for your business, is clear and clean. If you have issues, we all go through tough patches in life. Make sure you chat to your bank, your financial institution, and try and get help during that process. When understanding the credit history, what we look at is firstly, the willingness of the individual to repay the bank, and secondly, the ability to repay. We know that the ability to repay can be impacted by external factors, and we'll also always take that into account. When conducting your business, conduct all your business through your bank account. So it creates a track record to prove the turnover of your business, the revenue that you're generating. Secondly, and I think the critical part of our assessment is around affordability. We look at the generation of income, and this is based on the trend of the business or the projections that the business has. And I think Wayne mentioned this earlier as well. What's critical is that if you make assumptions in your projections, it's important that you base that on certain facts. So do your research, do your market research, and understand the assumptions that you put into a cash flow. Then we look at your expenses. We understand industry. We've got a huge amount of knowledge about various industries. So we understand the gross profit in the industries. We understand the expenses. So we'll be able to guide you and say, you're realistically projecting these or not. Ultimately, it's your cash flow that matters. Your cash flow that is able to repay your existing debt obligations and take on new debt obligations. And then we look at sustainability. We look at the industry, the life cycle of the business, the life cycle of the industry that you operate in, and understand if there's sustainability in your concept in your business. And lastly, we look at security or collateral. This is a secondary recourse that the bank has to access or get the money repaid. It's not primary. I think the first 3 aspects become critical, and then only does a bank consider your security. So just to sum up, I think keep a clear credit record, both for the business and an individual. Make sure your regulatory requirements are up to date with CIPRO, SARS, and so on. Keep proper financial records. Understand the cash flow of the business. process all your transaction through your business account, and then separate your personal from your business, so you understand what your financial position of your business is. And I think, this is where the CFO Centre can add a lot of value to clients out there. Thank you, Rowan.
Thanks, Mervyn. Some really comprehensive insights. Thank you. So to then just ask the question a little bit differently to end off is, what are the main reasons funding applications are rejected when they are, and how can people learn from this?
So I think number one is the formality of business. There are certain regulatory requirements that it's not the banks that require it, but you are allowed, because you trade a business, you need to have these. And these are registration with SARS, registration with CIPRO, to make sure your details are updated. So I think that's one of the aspects that a lot of entrepreneurs neglect. And secondly, it's around the trading revenue. So when we look at affordability, which is important, we look at the revenue, track record. A lot of businesses do not keep track records of their revenue. So I think financial statements becomes important. Here again, this is the value that an organization like CFO Centre adds, by offering that financial support to businesses so that your records are clear, and that you're able to prove this is the revenue trend of the business, and this is where we're going. So things like, your bank statements, all your revenue goes through your bank statement, your expenses are processed through your bank, financial statements, management accounts, that all talks to the history of the business. If you're a new business, your projections becomes important, and the assumptions on which those projections are based. Your gross margin, the reasonability in the industry. So remember, no business operates in isolation. In understanding the industry, we know the gross margins that you can expect from different types of business. So it's the reasonability of that gross margin. And then your expenses. We know there's expenses that you need to incur. You've got to have premises, you've got to have fuel expenses, you've got to have vehicles. So taking all your expenses and being conservative on those expenses. What happens if there's a fuel price increase? Have you taken that into account? And then finally, your debt obligations. So taking that all into account will reflect your free cash flow and the ability to repay new debt. A lot of businesses do not understand these financial aspects of the business, and hence do not get finance approved for themselves. So I think, the assumptions that you make in your business is critical. And these things are not things that you think of once off when you're starting your business. It's dynamic stuff that change. We know interest rate changes, your fuel price is changing. So you've got to take all that into account. The aim of business is to satisfy a need. If there's no need out there, you don't have a business. And not only satisfy a need, but you've got to be able to deliver your service, your product to your customers. So I think those are the critical things. Be realistic and conservative in your planning.
Thank you, Mervyn. Some great insights there, and I'm sure people will take home some real nuggets to use, practical stuff there. Thank you. We'll come back a bit later then, Mervyn, with some questions perhaps. I'm going to move on now to Quinton, and it is your turn this time, Quinton. If you could join us. Quinton from the Preference Capital Group. He's the Chief Revenue Officer. Quinton is a seasoned financial expert with over 2 decades of experience in the sector. He's a qualified CA. Quinton's expertise spans lending, investment, credit, and trading, both in South Africa and the rest of Africa. In particular, his focus over the past 7 years is launching innovative financial products tailored to the South African SME market. So welcome, Quinton, sorry.
Thank you, Rowan. Thank you for the opportunity and the platform.
Pleasure. I'm just going to launch into the first question, if you don't mind. What value do alternative financiers like Preference Capital bring to the market, and more specifically, the SME market versus
Perfect.
banks?
Very good question. Thank you again for the opportunity, and hi to everyone. The value we bring to the SME market as alternative financiers can be summarized as we really back the jockey. We like to position ourselves to say we are business owners doing business with business owners. So we understand the challenges in SA and what's required to succeed and be successful. So we're really backing the business owners in the SME space. When we look at affording credit or assigning lending facilities, we back the jockeys because we ourselves are actually playing in the same space as jockeys. Second, to the point, we definitely consume or take on more credit risk because of what we understand the needs are. So what do I mean by the fact that we take on more credit risk than conventional funders? We offer unsecured facilities to clients. So our unsecured facility is described as a facility that doesn't go and compromise your current income and security of your funder. So we can fund alongside or even behind your current financier on that basis. We typically also offer higher loan-to-value ratios on asset classes. So we not rely 100% on security to partner with our clients, meaning if you have an overdraft facility currently, your book is running at 10 million and your overdraft limit is 5, we're more than happy to consume that equity portion in that book by taking another 3-bar stab at your book and increasing the 5 to 8. You can still use your 5 million rand with your bank. We will come and plug and play additional 3 million for you. We often offer higher quantum debt facilities than is normally accepted in the market by banks. And more importantly, what we've designed the last 12 months, given the state of the economy, we offer take capital and pay later. We understand certain clients need to set up a plant. It takes time before you start generating and realizing your revenue. So we understand that to match cash flow and cash flow timing. So it's important when we give you debt that we're actually not putting more pressure on the business, but they actually have time to pay the debt back. So we do have options where we take a bit of a quasi-equity risk in the deal, where we tell clients, listen, take the capital, sort yourself out, find your feet, and then you only start to pay back the capital. So in summary, our facilities offer either revenue or turnover growth expansion. We give you facilities to grow your turnover. Alternatively, our facilities will look at creating efficiencies by generating more GP margin or bottom line for you. A point that's really important for us is to actually make sure our clients actually are more successful and grow better and more successful than us as the funder. In doing that, our clients typically de-risk themselves and they can come back next year for more facilities. That's basically the alternative finance space, how we look at things and how we play.
Thanks so much, Quinton. So just moving on then, as an SME and from your perspective, how can I strengthen my ability and probability of accessing the right funding?
It's a very good question. Obviously, there's a lot of points to be discussed here. I'll summarize it in 5, which I've experienced practically, and these are practical points to go think about. First, I think a lot of guys touched on credit behavior. Credit behavior is something, it's a small win, but it's so important to actually portray your credibility to a funder. Like pay your creditors on time, don't go in excess of your overdraft limit, make sure there's monthly fluctuation in your overdraft balance, and just make sure your credit bureau standing in your own personal name as business owner and that of the company is in good stead. I mean, those are small boxes you can check and tick, which is vital for any starting point for raising funds. A second point is stick to your story. If you, I think Wayne also touched on it, stick to your story. If you apply for funding, be sure for what you're applying funding for. I've seen so often clients change their minds and we change deal 2 or 3 times. So stick to the story. If you say you want to finance stock, take the capital, finance stock. Don't take capital for stock and go finance a plant or cover overheads. Stick to the story when you approach a funder for raising debt. A third point is matching your assets and liabilities. Make sure that you're actually raising short-term debt for short-term assets and long-term debt for long-term assets. I've seen so many times where clients go and encumber a property to purchase stock. If you're starting to raise debt that mismatch on asset classes and liability classes, you will soon run into cash flow issues because it's not sustainable. A fourth point, which is very important, is commit some equity into a transaction. If you're a business owner, and I'm not saying traditionally funders are looking for 10%, 20%, but be it stock finance, trade finance, asset finance, as a business owner, banks love it, or funders love it when the owner commits 2% or 5% or 6% equity. Try and contribute a portion of equity into the lending structure. That just gives such a positive sign to a financier that you committed to the deal with us. And this is where the partnership comes in. We want to make sure that the owner of the business actually participate in the funding with us. At the end of the day, you're going to make more money using third-party money to drive more profits, but put some equity in the deal. And the last point I want to make on this question is, please make sure that you're going to make more money with the money you're actually borrowing or that we're lending to you. Make sure your return on investment actually makes sense. If you're going to go and borrow money at 1% a month, you must try and make 2% on that borrowed money to actually drive profits. A lot of clients come to us and raise funding, and then the purpose is not clear, and or they haven't run a forecast model to say, listen, I'm going to use this million, but I'm going to generate 3 million. Make sure your investment case makes sense before you climb in bed with a fund and raising debt. It's so important to make sure that you use capital to make more profits. I always tell clients, the best way to run a profitable business is to use somebody else's money to make more money. But be sure you're going to make that money and not put the company at more stress by not paying third-party debt back. So those are the 5 key points. I think it's very practical for SMEs.
Yeah, brilliant. Some nice takeaways there. So finally then, just the $1 million question. In the debt raising landscape, how does it look and feel for the SA economy going forward for SMEs in particular?
Yeah, it's almost like that rugby game on Sunday night against France, I suppose. Sometimes you have to scrum here, and sometimes you need to kind of chase down a conversion. I suppose if you look at the landscape currently, it's very difficult for SMEs and business owners. Inflation is high, interest rates are high. The depreciation in the rand against the dollar when you're importing, your landing cost of goods are higher. It's very difficult to pass on the cost to your customers. My advice would be in the current landscape, if you go and raise debt, there's a few things you need to be sure of. First of all, make sure when you raise debt, it's either going to drive turnover growth for you, meaning go raise debt to buy stock to sell into your customer because your customer wants more of your product and he likes your product. Alternatively, if that's not on the cards for you and you find that the alternative or competitors in the market's taking some market share away, look at raising debt to create more efficiencies in your business around GP margins. For argument's sake, maybe buy a bit more in bulk or import a bit more in bulk, or actually pack your containers more efficiently that your landed cost of goods are actually low, or take out the FEC when you import to ensure that you actually get your cost of goods in rand terms a bit cheaper. That will place you in a position to actually generate more GP. And that's not saying taking unanalyzed credit risk or debt risk. I'm saying buy stock more effectively that you can generate an early settlement discount with your supplier. And then if you raise debt at say 1% and you get a 2% 30-day discount from your supplier, well, obviously that return on investment model makes sense. So please raise debt in the current environment, either to drive turnover or to create efficiencies in your GP margin. But again, these are very complex matters that business owners struggle with. And business owners, I've done analysis, business owners typically only think about these issues surrounding the business after 8 p.m. when everybody is tired. So you're not alone in this, okay? We as alternative financiers and also with the FD and CFO Centre are exactly positioned in the market for you to outsource these complexities. Let us help you work through these complexities, and then we can provide you with capital to work through those. And then business owners, the other comment I can make is be sure, like run analysis, be detailed in your thinking. Don't wake up and think you want to raise debt. It's a whole process you have to go through around analysis before you go raise debt. Climbing in bed with the wrong funder can hurt the business, and it can have sustainable issues and pressure on the business. So when you raise debt, it's quite a vital process that's of significance for your business. Make sure you get it right. If you're unsure if you're getting it right, chat to us, chat to the FD Centre, get a third-party view that's independent to help you through this process. That when we go through a debt raise process, we can tick all the boxes and actually generate what you want to generate for your business.
Thanks, Quinton. Again, some valuable insights, and I'm sure our audience will take away some stuff from today, from your conversation. Thank you.
Perfect. Thanks, Rowan.
Right. Moving on, I'm going to invite Gas Fernandez. Are you there, Gas, to join?
Right here. Yeah, morning, everybody.
Okay.
And
welcome, Gas. So Gas, is the CEO and founder of Pescaluna East Coast, a business that he founded 23 years ago in the year 2000. He has a passion for fish and was raised in the fishing industry in a family business. Gas has many years of diverse experience in the industry, both locally and abroad. During his career, he has had the opportunity of working in all the major fishing sectors of South Africa. Today, Pescaluna catches, processes, and markets hake, calamari, and bycatch products in the longline and trawling sectors, 70% export, 30% local. They are based in Hout Bay Harbour and employ over 200 people. So, Gas, to kick off with you, could you share your story as an entrepreneur of how you started your business and how you raised funds at the time?
Sure. Thanks, Rowan, and thanks for giving me the opportunity to share. As an entrepreneur, you're always starting out with nothing, everything to gain, nothing to lose. In about 2001, 2000, I left a sort of family environment business, a good structure to just to rest on, but that wasn't enough for me. And after 8 months of trying to trade and make a living, I quickly realized that to be an entity, one had to have a bigger stake in the industry and buy a vessel, have your own product, and get that to the market and have your own identity. That came with a challenge and with very little track record. So what I did was I approached a seller of a vessel at the time, and I managed to negotiate with him because obviously at this time, banks wouldn't even talking to me. So I approached the seller and I said to him, would you be okay if I put 50% down and you finance the balance over 60 months? It took some negotiation, but they agreed. I then turned that around and I approached a client in the Spanish market, and I said, would you take 36 months of exclusive supply from this vessel I'm buying for 50% of the value of the vessel? And he said, fine. So I took the money and I paid the deposit and I started fishing. About a year later, the season, I took that track record and I approached a financial institution and refinanced the business again. I paid the seller of the vessel with a discount, of course, and then continued the business. So that was my little kickstart, a little bit of luck, and we managed to have good fishing. But it was a great start with no money, and we were up and running.
Some real innovation from an entrepreneur there. Thanks, Gas. So just shifting gears a little bit, would you share some entrepreneurial insights for the audience around some of the struggles over the years and what you've overcome, maybe some learnings that could help the audience?
Yeah. So our industry is quite unique. I mean, we're on the primary sector on the agricultural side. So we're faced with, I'd say, two major problems or major challenges. The environment, which we know is changing, and the weather patterns are difficult to predict. And then the political landscape, where this leads to access to resource and your black empowerment structures in South Africa and so forth. So these are two landscapes that are constantly changing and not great for a business plan and not great for any financial institution that looks at you. We also recently had a vessel that burnt out in April this year, which hurt my supply chain a lot. It took about a third of my hake, fresh hake for Europe supply out of the system, which again affects your business. And these are things that you cannot plan for. And my little tip here would be that, what's getting me through, and it got me through, afford the best people possible around you. And with that strong team, you'll overcome many, many challenges that are really unforeseen sometimes.
Excellent. Thank you so much. And then as far as funding goes and your relationship with the CFO Centre and Robert, who's going to be up next, in terms of accessing the right funding, how has this relationship supported you over time?
Well, Yes, you know, with funding, and it was said earlier, you know, by Wayne and Quentin, and it's about also your track record. So primarily, you need to look after your personal track record, and as an entrepreneur, you are inclined to take risk, but it's important to keep your track record and your financial, you know, updated financial records on hand. I think that's a very important. I think also in any industry, you know, approaching the right financial institution is important. So try to find a financial institution, a bank that understands your industry. There are many good institutions that wouldn't even look at the fishing industry. Not that you're just wasting your time. They just don't have the appetite for that type of risk, and they don't understand. And then build that relationship around that. I think that's important. When it comes to CFO and Robert, who's assisted me, we've been with CFO Centre for the last 4 to 5 years. And Robert's actually the second individual that has worked with me. And he helps, and CFO have helped an entrepreneur like myself. You know, we have many ideas, many plans, many aspirations, but someone has to put it in writing. Someone has to put it into some financial package that a financial institution will understand. And that's where Robert has been great for me. And we recently purchased a factory trawler from New Zealand about 2 years ago. It's been a long process. It's been a tough process because all our budgets and our projections haven't really worked out as it does in the industry, with fuel prices that go crazy, and fishing with the El Nino that we're currently experiencing in the Southern Hemisphere during this last 12-month period. These are factors that, having someone like Robert on board, we've been able to constantly update the banks, the financial institutions, and rework it. And I know things have changed 3 or 4 times in this process, but building the trust and keeping the banks informed about your challenges has helped us. And they've also seen that we've grown the business, but it's cost us a little bit more than we had anticipated, and that's where maybe the financial package that we started out with was just capex. Now it's slightly a bit of an overdraft and a little bit of debtor finance too. So we package now a financial solution for our business.
Excellent. Thanks so much for sharing your insights with us today. And I'm sure the audience has valued what you've had to say. Thanks, Gas. Right, I'm going to segue into our final panelist then. That's Robert Rousseau, also from the CFO Centre. You've heard a little bit about Robert already from his client, Gas. So Robert is a highly experienced professional. He looks after a portfolio of clients in the Western Cape, including Pescaluna. He has extensive business acumen and has held several senior management positions in different countries across the functional spectrum. Robert's approach to problem solving is innovative. He enjoys challenging environments, and Robert has a passion for assisting entrepreneurs with achieving their goals and growing their businesses. So Robert, welcome. And I'm going to just move straight into your first question. If you could share your experience of how you've supported a client like Pescaluna with accessing the right funding.
Hi, Rowan, and hello, everybody. Thank you for having me. I think I was very fortunate with Gas when I walked into the business. Gas had already a well-established relationship with the bank, a strong balance sheet, and with a bank that understood the industry. I think Gas pointed that out earlier. So the fundamentals were already good. And when I came in, one of the major things we were trying to do was purchase this vessel from overseas, which was interesting in itself. We spent a little bit of time packaging, putting a nice package together for the bank. And it was nice because it was a new project, almost standalone. It was very easy to quantify. These are the costs. This is the investment. This is the return. And the return were very, very, very good on paper. Obviously, as things go by, things change. I think the cost of the vessel was a good few bar more than we had planned. and that put us into a bit of a difficult position, and we try to fund it from the company's overdraft, which is not ideal, and it put us in a bit of a tight spot. And then when one of the vessels burnt out and we had other dramas, the fuel price went through the roof, the business actually started coming under a bit of stress because we borrowed so little against the actual value of the asset. So we looked around and said, should we either refund the asset and take out a bigger bond on the vessel, which was no problem because of the value of the vessel, but we actually decided to rather consider moving down the debtor route, largely because the business is very seasonal in nature and a lot of the business is export. So we said, okay, today the bank does not really give any value for export debtors. They're unsecured. The bank can't collect from overseas easily. They take comfort, and comfort doesn't add any value to us, frankly speaking. So we said, okay, what can we do? And we spoke to the bank and said to them, how do we go forward? And they said, why don't you consider, factoring the debtors? And they were talking about local and overseas, and eventually the local insurance is so expensive. We decided just to home in on the overseas market. We only have a handful, less than 10 large customers. We thought it's a lot more manageable. The insurance was better. And we embarked that road where we actually try to get funding which actually stretches and shrinks as we need it. And we thought that was a good match, the right kind of match for our business. Of course, there's a lot of learning and teething, and it's all very new. But that's kind of where we've moved over to.
Excellent. Thank you for sharing that with us. Some interesting insights. So just in terms of advice, Robert, on the do's and don'ts side, I mean, what are your sort of practical advice that you can give to the audience about how to succeed with your finance applications? As a CFO, what advice would you on the do's and don'ts side?
I think we've heard some great tips already from Wayne, Mervyn, Quinton. I think there's some great nuggets come through there. If I think about it and I move a little bit away from the numbers side of the business, we talk more about the relationship and the quality. So the qualitative aspects rather than the quantitative aspects. I think firstly the basics is, and I think it's been mentioned before, if you're going to go to the bank, they're going to ask for your financials, they're going to ask for your management accounts, they're going to ask for your SARS statements, your registrations, and that. Get it ready, because the process will just drag on if you're not up to speed. So get yourself in a good starting position. I think secondly, the banks, in my opinion, look very much at the jockey, and Quinton used the word jockey specifically. I think the banks do look at the person, not just his bank statement, not just his creditworthiness, but even his lifestyle. I mean, is the guy actually pillaging all the money out of the company? So the bank's putting money in and you actually having this crazy lifestyle. I think those things actually are relevant. I think more than that also is the bank is looking at, do I really want to do business with this person? Is this person in it for the long run? It's a credibility thing, and I think that is a very strong aspect. So it's really a lot about you as an individual. You're selling yourself and your business in terms of securing funding. The other thing I think we could focus quite easily on are really relationships and people. It's a banking relationship. It is a people relationship. And I think if we understand that it's a partnership where trust, respect, openness, honesty, transparency are imperative, I think that goes a long, long, long way. I think if you're going to take it as an adversarial relationship where you're going to hide the truth from the bank and you're going to try and pull the wool over their eyes, I think you lose your credibility. And I think you need to have a long-term perspective on matters. If I move forward, I think to be professional is paramount. I personally when I first look at any company's accounts, I look and see if the accountant is putting management depreciation into the books as a small example. And if that little attention to detail is there, then the guy's probably doing a fairly reasonable job. You find a lot of people only account for depreciation at year end when the auditors come and do some work for them. And I think I think you must be professional. Also, I've noticed my emails get quoted verbatim into the credit committee. So when you write an email to the bank, be careful. They are taking what you say literally. So I think professionalism, there's no standing second there.
Thank you, Robert. Thank you.
Yeah, Karen.
I'm going to cut you a bit short there. I hope you don't mind. I'd like to just create a bit of time to ask some questions to the audience. So thank you for all of that input you've given, and I really appreciate it. I'm going to ask the rest of the panel to rejoin because I'm going to pose a few extra questions now from the audience, which I've picked up at the moment. So the first one is from Etty Claassen, and that's a specific question around manufacturing, and perhaps one of the relevant members can just respond to this. We've been struggling extremely to raise capital for a manufacturing entity, purely due to little securities to offer. Debtors normally reside with the bank for the overdraft facility. Without property, one is not able to raise capital. Any suggestions? I would say that's probably Mervyn or Quinton, if there's any suggestions. Manufacturing company doesn't low security. Debtors look like they've already been secured as some kind of facility. And I don't know, any other suggestions for someone in that position?
Yeah, thanks, Rowan. So again, if you're looking to finance the plant, I mean, the focus must be on the plant and what generate kind of income that plant can generate to repay the debt. It's almost like doing a project finance ring fence facility on the side. What I always tell clients, when you go and do plant finance, just keep a cap on, because you will need to increase your working capital facilities at the bank either way to stimulate more raw material going through increased capacity. So people always just look at the plant and forget about, oh, my debt is going to grow, going to carry debtors for a longer period. Oh, my stock holding needs to increase because I need to put some more raw material through the plant. So I think in that scenario, if you fill up with your bank, go and approach your bank to increase your overdraft in any event because you're going to need it. Get the alternative financier to kind of de-risk the bank and finance the plant for you. And we'll look at financing the plant solely on the plant value, and also then structuring a loan profile that matches the cash flow on the project finance basis against the plant. Like I mentioned, it's not effective from a funding perspective to use non-correlated property to secure a plant if the fact on the table is, or the need or the purpose is to finance a plant to generate more EBITDA. So keep your story right.
So matching the funding again.
100%, and for the right purpose, and stick to that story.
Excellent. So thank you for that great answer. I hope that helped. So then just another one here. Can a business issue equity as collateral? And when will the exit point be for the financier? Maybe Mervyn could respond to that. Do you take equity as collateral, as security?
So, Rowan, as a bank, we don't take equity as security, but there are financial institutions out there that will consider taking up equity. I think, just in terms of if you're looking at bringing in an equity partner, what's important is that you've got to prove that the return is worth their while. With regard to the exit time and the exit amount, that will have to be negotiated between the parties. Thank you.
Ron, if I can just add here, I think funders don't like to take peer equity because we don't want to get involved in your business in terms of business decisions. On that point, you rather want to raise like a quasi-equity loan that's got the nature and flavor like equity, but it's not an equity instrument, if I can call it that. I think by issuing your shares and giving your shares away as security, it might not be effective because you don't want the funder to be involved in your daily decision-making. Rather look at a pref share or a quasi-mezz loan with some profit share on the upside from that basis. And again, look at matching cash flow and then decide on the price. It will be more expensive than senior debt, but it will fit the purpose that you actually want to raise the debt for.
Thank you. Thank you. And then another one here for the bankers that we'll look for the bankers. If you have security with a very low loan to value ratio, where it is highly secure, how much influence does that have on the borrowing rates to offer? A very low loan to value ratio, does it influence the borrowing rates?
Yeah, I'll take that one. So most definitely, I think when banks look at funding, it's the return they make on that funding, and part of that we look at our loss. So we have something called loss given default. So should the client default, what will the bank's loss be? And if you consider security, that impacts on your loss given default. The lower that is, the better pricing that you can get. So it definitely does impact your pricing.
Thank you. Gentlemen, I really thank you for your time this morning. We have run out of time. I'm going to just do a wrap up. So those whose questions were answered, I hope that was helpful. The others, we will try and respond to your questions and get back to you. And then to our panelists, just thank you again very much for your time. I just want a few little wrap ups from me. And the takeaways, I just hope there were some good nuggets and takeaways for all of you. So for me, the big things that I got out of it was try to use a professional to help you prepare your funding application. You know, for an example, a CFO. Approach the right institution for the right type of finance, match the finance. It's sniper approach versus shotgun. Ensure your personal creditworthiness is favorable because that affects your scores. Understand the cost of debt funding, especially really well over the period of the funding cycle. And ensure your financial forecasts and your numbers are reliable, particularly the assumptions, the presumptions, all of the guesswork that needs to be done. The research is properly done around that and tested. So those are my little takeaways. Thanks again to the panelists for their time and wisdom shared. I'm sure you got value out of it. And if you'd like to reach out to any of the panelists, we will be following up with an email, and then you can respond with your question or need to us, and we will pass that on to the relevant person. Before we close, could I ask that you just take a short survey, which will pop up on your screen by our webinar managers. And if you could just answer the questions, we need to get the feedback so we can improve for next time and also get some more insights from what would be valuable for next time. And yeah, I'm just not sure how that form is going to pop up now, but I think before you close out your webinar, you will find the form and you can just click on there and respond if you don't mind. So that is it from me. It's 11:59. And we'll close out now. So thanks very much for attending. Until next time. Thank you.
Thanks, guys.